This is a podcast from the Business Times.
General elections in India have always been a major event for the stock markets, which introduces a lot of uncertainty among investors thanks to increased volatility. Markets had turned jittery due to the low voter turnout and intense competition in certain states. This is Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim.
In fact, if you see the mutual fund inflows, in May alone, it hit a new milestone. And then the net investment, there are some thematic sectoral funds that are also playing into this whole up move. And then the market cap neared 5 trillion, which puts India in the ranks of US, China, Japan, and Hong Kong. So yes, a tumultuous start, but thereafter calm has prevailed and equity markets are up and away.
And joining us today, Radhika Rao, Senior Economist and Executive Director at DBS Bank. So it's looking like markets didn't react too negatively in the immediate aftermath of the elections, even though the results weren't ideal for the ruling party. People generally don't like surprises.
So there was quite topsy-turvy volatility as you would have it. The elections ran for almost 2 months. So everybody was waiting with bated breath for the exit polls to start, which was on the June 1st evening after the last polls closed. And what that showed you, and that spilled over to the starting of the next week, was that the incumbent government, which is already expected to win, but the coalition as well as the ruling party, the exit polls seem to suggest there's going to be a very strong wave of support for them, with one or two pollsters, in fact, calling for an absolute majority. Not surprises, stock markets really rallied very sharply ahead of the actual results. But then you saw a quick correction thereafter when the actual results were announced, the official results, rather when they started trickling in. And it became quite obvious that the optimism in the exit polls did not get reflected in the actual numbers. Those couple of days or starting of that week, stock markets were in particular very, very choppy. And I think you could say that to the broader markets as well, which is the bond as well as the FX markets. But what you've seen since then is that the optimism has returned. There was initial worry about how the numbers went. But after that, I think sense prevailed that if the incumbent government comes back, regardless of the actual numbers backing them, then everything would be status quo and there'd be continuity. And I think markets came to realize that. And since then, stock markets have again, gone back to record highs. And you've seen, for instance, taking a step back away from just the elections, there have been a big domestic institutional participation in the stock markets, and that continues unabated.
But unabated participation in the stock market may seem challenging, with the government now needing to include coalition partners in decision-making. Too many cooks and all that.
Certainly, I think what sets Indian democratic setup apart is essentially coalition setup in governments is not something new. If you see the past 4-5 decades, there have been largely coalition governments that have led the country, apart from, few terms here and there punctuated by single party majorities. So what we have on hand is the last 2 terms of the incumbent government. The ruling party as well as the coalition actually came out with absolute majorities, right? So there have been outstanding numbers. We've not seen that in a very long time. So that kind of set the base and expectation at a much higher level going into these elections. Those optimistic numbers that the exit polls showed up didn't tend to get reflected in the actual results. Yes, markets were concerned a bit earlier that there's going to be a coalition set up and who's going to actually pull the strings. But what you have in place is the ruling party, which has come out with still a significant seat tally, working with its 2 main major allies who have stuck with the coalition government. And then I've got a lot more smaller allies as well. So they remain very much in office. So put together, they are well above the majority mark that they require to stay in office. So that would be the context, which would be very important to also get a sense of whether the government will be stable or not. The traditional allies have stuck together this time around, and we do expect them to complete the term.
How will sectors which have traditionally been sensitive to elections react moving forward? Might they continue to react the same way? And if not, why?
We spoke about the choppiness in the markets ahead of the election, actual election results, and in wake of the exit polls. you kind of did get a sense of what the investors were betting on. You, in fact, saw pro capex because of the government's orientation in the past 2 terms in office. They've had a very clear orientation towards capital projects, infrastructure, defense spending, manufacturing focused companies, some IT, some banking as well. So you did see a lot of sway towards that. Post the actual elections, then you saw another swing. Now, where will the government's priorities be post this kind of an outcome? And then you saw, for instance, FMCGs do very well in wake of the actual results, because the interpretation was that the government will have to do a bit more of consumption-focused stimulus to be able to, make up for the kind of weakness seen in the numbers coming out of the actual results. So given that mix, there's been quite a sway. I would personally take it as, you bet on the near term and you bet on the economy's structural story. And basis that, reasons to believe that the equity markets could fare better. Again, I'm no equity analyst, but when I look at the near-term and structural story, there are a few sectors that really stand out, right? So the near-term, certainly consumption, banking, healthcare, autos. And if you're betting on the structural story, then of course you've got industrials, pharma, logistics, metals. That is where you would see a lot more interest. The valuations are also quite high in terms of investors out there that I think that need to make a judgment call. But from a macro point of view, taking a short-term lens and long-term lens certainly will make a few sectors stand out more than the others.
Still to come, is India investable? Bottom line. And what could derail the optimistic outlook? More with Radhika in a moment.
Money Hacks now comes to you every Monday. Get useful financial tips every week. How much to save, what to invest in. Howie Lim asks the experts, so you have the answers. Money Hacks by the Business Times. Every Monday, go to bt.sg/moneyhacks or wherever you get your podcasts.
And now, back to Money Hacks from the Business Times.
Radhika Rao from DBS joins us today to talk about opportunities in Indian markets in the aftermath of the general elections in June.
The risks are certainly equally important to keep an eye on. I think domestically, if we were to assume political stability, I think then it comes down to some parts of the sectors or growth engines that might face a bit of growth risks, especially if you talk about the agrarian part of the economy.
It sounds as if risks go beyond the political and economic arenas. What is something that could derail the current optimistic outlook for the Indian economy and investment opportunities?
We've had in Southeast Asia as well quite a strong heat wave. India has also had its fair of high temperatures, especially in April, May. Some of that is spilling over into June. And we are entering a period where there's quite a crucial monsoon period. It's called the Southwest Monsoon. It started on a strong note, but thereafter you're seeing about a 20% drop or a shortfall in the rainfall that should have happened by now. So that's a very important thing to keep an eye on, because this is important from the point of building groundwater levels, building reservoir levels, which are much below where they were same time last year. Monsoon is something to keep an eye on domestically, as well as, weather, and because that impacts farm output, which in turn impacts what reaches the final consumer. And it certainly has a big impact, particularly on perishables and on inflation. So domestically, I would think that would be a bigger risk to watch out for. Outside in exogenous, of course, there are a lot more things. Geopolitics problems are still simmering. Oil prices have been very choppy, but anything north of 9,500 is a risk, because the economy is a major importer of commodities, especially of oil. So that's one. And the second one is, of course, general policy bias in terms of what the global central banks are doing, especially the Fed, when it starts cutting rates and all of that. Though we don't think the Indian central bank is going to actually follow them step by step. They have made it quite clear they want to be independent in their decisions. So I think the Indian central bank will be driven by domestic considerations, not so much just what the Fed does. Nonetheless, it's something that will make an appearance in their dashboard. So I would think domestically and exogenous, these would be a couple of things we'll be keeping an eye on. India is predominantly driven by domestic demand, so that is how we think the mix will continue. A slight support from external trade, but not as much. It'll still be very much consumption and investment.
Radhika may be an economist, but I'm sure she's been asked for investment advice from family and friends.
But I would think that there are investors who look for short-term returns, and there are investors who look, the patient ones who hold on. And at that point, when you do have a structural story in play, there are a few things you would keep. And there are many thematics which are actually at play, right? You've got climate change, you've got sustainability on a thematic front, and then you look at a country angle, and then you would look for, some kind of drivers which will remain in place for a long time, especially things like, is the economy, has it got good demographics? We're talking about a point in time now that many developed countries are in fact facing demographic challenges, has got good barriers against geopolitical risks, and does it stand to gain from this fragmentation that's going on? So when you look at it from that angle, Asia stands out. In Asia, ASEAN stands out, and along with ASEAN, India stands out as well, which is quite well placed on all these fronts. Insofar as it as a market is concerned, it certainly remains a very viable option. Either you go thematics route or you go country angle. And if you go country angle, then of course we could play on the near term as well as the long term strengths of the country. Valuations are something that's always a concern. But again, if it is backed by better corporate profitability and a 7 to 8% growth number, then it gives you a bit more confidence on the path ahead.
Radhika Rao, Senior Economist and Executive Director at DBS Bank. Next time, has China bottomed out, since the data is still mixed on where the economy is headed? Let's find out. This has been Money Hacks, a podcast series by the Business Times. I'm Howie Lim. Till next time.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.